Hello, everybody. Wade Comeaux and Jeff Johnson with Catalyst
Howdy.
Funding. Very excited to go over the real estate monthly market update for January. So, very interesting data and very excited to go through that with everybody. Uh, the disclaimer, I'll cover that real quick. This is for general information only. We're not intending to give you any investment advice. You must do your own due diligence. Jeff nor I accept any responsibility for investment success. By attending this, you're acknowledging the Catalyst and its agents do not assume any liability, and you're responsible for any potential losses or damages that may be caused by the information within this information update we covered today. All right, couple things. Catalyst value propositions. We are very excited to be a one-stop shop for your hard money and permanent financing loans. We are built by real estate investors and former wholesalers by for real estate investors. So we understand the wholesaling business, and we really have been passionate this year about deepening relationships with wholesalers. So if you're a wholesaler out there and you want to learn about how we can help you succeed in 2026, we would love to hear from you. Um, we also have a single point of contact for all your loans, and with one soft credit pull, you can get qualified for the wide variety of products we offer, including hard money to purchase and repair distressed real estate, as well as conventional and non-conventional or DSCR loans. Those are uh, no income doc loans. So even if you do not have a full-time job or easy to document income, you can still get a loan to hold properties and be a landlord. And we have DSCR products with FICO scores as low as 660 and no actual positive debt service coverage ratio requirement. So some very flexible products that can really help you out. Next slide, please. Jeff, do you want to kick off Houston?
Yeah, sure. So before we do that, real quick, I just wanted to say something about the market, just kind of giving an update on what we're seeing on the deals I come across. I highly recommend that if you are wanting to be a real estate investor, now is a good time to get in the game. Just kind of boots on the ground. A lot of the deals that I see, I'm seeing a lot of deals. There are a lot of available deals. We're working with a lot of different wholesalers that are bringing off market properties to investors. I'm seeing a lot of deals, and I'm seeing a lot of cash out of pocket that is significantly less than the quote unquote heyday of the pandemic 2021, 22,
Right.
even 23 to for an example. So there's still a lot of deal flow. There's just less competition, less buyers. So the cash out of pocket is better. So if you want to be an investor, now is a great time to pick up some deals with less money out of pocket. I think, yeah, as you'll see here, I think the market is pretty stable. It's kind of back to normalized conditions, in my opinion. Also, just being candid, even though the cash out of pocket is a lot lower than it used to be, it does take money to do these deals. So, we're helping a lot of investors do cash outs on properties that maybe they bought in the past, rentals or their own primary. It's a really good time to get some cash and to pick up some properties because, like I said, the competition is not nearly as much as it once was. So that's my 2 cents of what's going on the ground.
Yeah.
So Houston, I'll cover the numbers and then we can kind of talk about it. So 7,400 home sales. If you compare that to last year, call it 7,200. 6 years ago, 7,700. So if you think about how much the population in Houston has grown in those 6 years, and there are less home sales now than there was back then, you look at the active listings, there are, and I think Houston is one of the, if not the top, one of the top markets just with available product, like active listings, 52,000 listings. Compared to 6 years ago, there was 37,000 listings with roughly the same number of sales. So for a buyer, there's a lot more to choose from. There's a lot less competition than maybe what you're used to. Average sales price 425, pretty flat relative to last year. COVID, 6 year average, you're looking at 37% on average, but in the 6 years since COVID. Median sales price 335, again flat, up 33%. pre-COVID. Months of inventory, 4.5, which is a half a month higher than it was last year. But if you look in Texas, it's a pretty average number. And then days on market, 64. That is, we'll go cover the rest of the markets here in a little bit, but 64 days on market is the lowest in Texas by a good bit. So it's a steady market. There's not a lot of fluctuations. That's one of the reasons why folks that rank markets typically rank Houston highly, is because we're so reliable. Looking at leases, rents are flat. Obviously, from 2019 to 2025, it's looking at almost like a $500 increase. So almost $100 a year is consistently what it's gone up over the last 6 years for landlords. Days on market a little bit longer, but overall, it's still a very solid market. Wade, anything?
I would echo what you're saying. I think the market is stable, but it is probably one of the best buyers markets in the country and in Texas because of the inventory. And you should not be afraid of a buyer's market if you're a real estate investor. Like, that's a good thing. You have to be more cautious if you're flipping, but if you're a buy and hold investor, it doesn't get better than a buyer's market, right? There's more ability for wholesalers or yourself to get discounted opportunities. You have more leverage because there's more inventory. That is nothing but positives as far as a buy and hold investor. And we're seeing very successful flippers too. We have some flippers, they're just buying at a good number. They deliver an excellent product and they're crushing it. You just have to be more cautious in a buyer's market as a flipper.
Yeah, that's kind of what I was saying earlier about there's less competition. So, and there's less out of pocket. So if you're a flipper, like Wade said, if you can buy it right, do a good rehab, price, do the rehab better than the market and price at maybe slightly above market. That's where most of our people are having success flipping properties. Rentals, it's easy. It's much easier. But flips,
For sure.
you just got to buy it right, and you can still execute and still make money. We have plenty of borrowers that are crushing it right now because they're buying them so deep.
Yep. Let's move to Dallas. So Dallas is interesting because Dallas was, far and away the year over year growth leader in both average and median sales price for quite some time. But now they are down 4 and 6% year over year. Still, the numbers from pre-COVID are the strongest in Dallas. Dallas has a great long-term track record. And I think this is not going to be a permanent scenario in Dallas by any means. There's too many positive factors from the job market and other factors that say this will be eventually turned back around. But that is presents an opportunity there in Dallas for sure, because the prices are coming back a bit. But if you look at the months of inventory, still much lower than Houston,
Yep.
much lower than most of the other markets in Houston. Now the days on market is comparable, so that's not a massive difference. But the months of inventory and also the home sales relative to the total active listings are not as big of a disparity. That total active listings today is only 8% higher year over year, 19% higher pre-COVID. Where when we looked at Houston, I think it's the number of homes on the market is up 40% from pre-COVID, if I'm remembering correctly. Yeah, that's a big number, right? So
Yeah.
a lot more inventory in Houston, a little bit more of a buyer's market despite being flat. But I still think if you look at that historical rent rate over time in Dallas is just really strong and continuing to grow. So I think, although the year over year is down 8%
Yeah.
this year, it's up 24% over from pre-COVID too.
Yeah. Yeah. And just most of this data coming out of Dallas, I believe, is like the Dallas metro proper, like the smaller, tighter group of Dallas. Once you get out into the suburbs and you get out into the tertiary markets of Dallas, that's where we see a lot more deals for buy and hold investors. Like
For sure.
we met with some Dallas wholesalers, and most of the stuff they do inside the city is for flippers, just because of the price point. It's hard to cash flow at a price point of $500,000. And you're right. Like the rents have come down a little bit, um, and the market's come down. But and not to spoil it, but there is a slide a little bit later that talks about Dallas and how it's becoming a lot more affordable because while these prices are dropping, the incomes are rising. So, like to Wade's point earlier, I don't think this is a long-term trend. I think this is probably a little bit of a backlash from the massive run-up they had. Um, and again, this is these prices here. These are for flippers. Flippers are they need to be a little more careful and buy it right. But when you start getting outside of Dallas, you start seeing price points that make a lot more sense for buy and hold investors, and that's where we're seeing most of our deals.
For sure. So let's move on to the next slide, which is a pretty exciting success story there, Jeff.
Little LL Cool J, don't call it a comeback, right?
Yeah.
So San Antonio, relative to last year, home sales are flat. Listings are flat, actually.
Hmm.
Um, Now, 6 years ago, same number of sales, a lot more listings. So that would lead you to believe it's more of a buyer's market. The part that's just, I got to look this up. It's dumbfounding to me. The average sales price has gone up 5% year over year. That's a big jump.
Yep.
So, and I remember, I don't know how long ago it was, but I remember doing these webinars and talking about how San Antonio, the prices were really, they were down and they weren't really seeing the resiliency of, say, Houston or Dallas. And I wasn't quite sure why, because it seemed like a relatively good market. And that's kind of coming to fruition, I guess, because while the other markets are flat, in Dallas's case, it's down, San Antonio's up.
Yep.
Up to 375. Median price is 310. Months of inventory 5.3. While it's the highest in Texas, it's certainly not obnoxious. Now the part that is obnoxious is that days on market,
Yeah,
and this is
that's
the
amazing.
part that really baffles me. Is 92 days on market, which is actually Austin. And I think Austin and San Antonio are probably trying to blend in a little bit. Like Austin has a pretty high days on market, but relative to Houston and Dallas, it's much higher. As a
Yeah.
reminder, Houston 64, Dallas 70. San Antonio 92 days on market. That is, you would think you're going to see prices just start plummeting, but they're not. And so that's the part that I'm trying to wrap my head around as to, the prices are stable, they're going up, even though the days on market are a lot higher. So, if you're flipping, like we said earlier with Dallas, it's all about the buy, and you need to account for holding costs. So you probably need to add it in. Let's be real. We're making I'm making a big deal of 92 days. If you look at Houston, we didn't talk about it. It's 64. It's only one extra month, so it's not the end of the world. One extra month, you just got to account for one extra month of holding costs before you can sell your flip. Um, but anyways, overall, San Antonio showing a lot of resilience.
For sure. For sure. Let's go to Austin. And Austin is oftentimes Austin and San Antonio are they're very close, so they're in proximity, so they're somewhat tied together. But you
Yeah,
mentioned the days on market, almost 3 months as well. But and not going up, it is a 3% reduction year over year, better than Dallas, not as good as Houston, and definitely not as good as San Antonio, since San Antonio's up pretty significantly. But that median sales price over time since pre-COVID is pretty much in line with San Antonio, pretty much in line with Houston, not at the level where Dallas is. Dallas is still the leader since pre-COVID. But that I looked, we did a looked at a trend line a few months back. I can't remember exactly when, but this has really put Austin back in line with its historical appreciation rate because it just went up so outrageously during COVID that it needed to get back in line with those historical rates. But almost every month or every other month, there's some prognosticator or analyst that comes out with all the reasons that Austin should continue to have appreciation growth. I think this is a correction. When things go up too quickly, there needs to be a correction, but there's a lot of data around Austin. There's no area that is more tech focused that's really becoming the tech hub of the United States. A lot of that is moving out of Silicon Valley, especially with that new billionaires tax that is supposed to be rolled out there potentially. So it's
yeah,
supposed to be voted on, which is a net worth tax. Um, that I think has a lot of the people who are founding these companies and investing in them really thinking about moving to Austin. There's so many of these people from Silicon Valley moving to Austin right now. It's really pretty incredible. So I
Yep,
think that Austin should really go up in value in the next few years because of that, because those people are not only going to be very wealthy and afford expensive homes, but they're bringing jobs that are white collar,
that's the thing.
high
Yeah,
earning jobs,
I mean,
right?
yeah. There's only a handful of people moving, but the key is, like you said, they bring opportunities and businesses with them.
For sure. All right, next slide.
So I cover this. So Zillow's market. This is just a prediction for 2026. I'll read it and we can talk about it. So Zillow forecasts home values to grow roughly 1.2 in 26, which is a normalized market compared to the pandemic era appreciation of 12%. We talked about that. Mortgage rates. So this is pretty interesting. I've seen a lot of different people predict there's a little more wider spread on predictions on the rates, but they feel like the rates are going to drift in the low sixes. Um, but I don't think they think they're going to get lower than that. And then housing inventory is expected to rise. Zillow estimated 4 to 6% more active listings as rate pressure continues to ease. So, I think 2025 was, if you look at price appreciation, it was flat over as a country. So 2026, I think a 1% increase is relatively that's relatively normal. I know like normalized appreciation is higher than 1%, but coming off of a zero and with not a clear reduction in rates on the horizon, I think 1% is a good guess. One thing that they did, I picked up in the article, I think they said in 2025 there were 24 quote unquote down markets, and they're predicting only 12 this year. So, um,
Hmm.
I think it's a little more of a normalized recovery type of year relative to 2025.
Yeah. All right, let's go to this next slide. I found this very interesting. There was an executive order related to large institutional investors in single family homes. And while they still relatively make up a small percentage of the overall owners of single family homes, it has been going up significantly recently. BlackRock and some of these other groups you guys may have heard if you've been in the investment game for a while, OfferPad and Zillow making outrageous offers, especially during the height of COVID. A lot of those companies have either got into significant financial difficulty or even filed bankruptcy because they were overpaying for homes. But I'm personally a little bit more of a libertarian, not necessarily want the government to be in overly regulating businesses, but I do think if you are a single family investor, this can only be considered a win because whenever these groups are kind of buying up all the inventory, it can make things more difficult for us to find opportunities. And I do think it puts some unnecessary upward pressure on home prices as well whenever they're scooping them up in that way and overpaying for them. So, um, it's a little bit difficult to know exactly how they're going to execute on this, but basically, from what I've read, the order says that the agencies that regulate not only the entities that have been buying the homes, but home acquisitions in general are really going to try and take a little bit more of a firm stance on making sure that they're not buying too many of the homes. The execution part is a little bit fuzzy to me, but just the overall tenor, I think, could be good for real estate investors. What do you think, Jeff?
Yeah, a couple things I noticed because you're right. It's like one of these things where you see an executive order, like, okay, what does it mean? What are they going to do? To your point, a lot of it was the tenor, but some of the things were more specific. Like it was, and I'm not sure how they're going to do this, but if there is a foreclosure, they're supposed to give 30 days for that foreclosure to be bought by an owner occupant or a nonprofit.
Yeah.
So if you're buying foreclosures, this I know and a lot of folks do. You probably want to pay attention to this because it might affect your ability to continue to buy foreclosures. So I would definitely keep an eye out for any kind of more guidance or details on how the program's actually going to work. But from what I read, it said 30 days from a foreclosure, owner occupants or nonprofits will be given preference to buy these properties. Um, I did they did one of the things that they exempted was like build to rent type of deals. Like
Mhm.
those are not going to be included. So I guess obviously if you have a lot, if you prevent people from building inventory, it could have a negative effect of raising prices even higher. But to your point though, like it is, I I looked a little bit at it. The percentage of properties in the country that are owned by landlords, like small landlords, meaning less than 100, is I think 12%.
Mhm.
And institutional investors own 1%.
Yeah.
So it's not, it's, I'm not saying it's not going to have some impact, but when you're cutting out the guys that only own 1%, um, we'll see. We'll see what happens. But it's
I think the trend line was what was concerning, right? It was
sure.
trending in a direction where that 1% could go up exponentially. These guys have unlimited access to capital, and in certain markets, they were definitely scooping up a lot.
Yeah. Well, Houston and Dallas were, I mean, sounds like it's not that big of a difference, but 2.2 and 2.6 respectively. So as a percentage, it's okay, over 100% more. So Houston and Dallas did have a lot more institutional buyers than the average of the country.
I had also read an article that said something about some of these institutions using a wide variety of companies and layers of ownership to hide and not fall under the institutional
100,
category, which which would make sense. I mean, I could see people doing that. The last thing I did notice on the article that I read is it did say the order tasks the White House with preparing legislative recommendations to codify these policies so that large institutional investors do not acquire single family homes. So while they have not put a lot of specificity into how they're going to do it, that tender does say they want to preclude them from doing it at all, which is pretty
yeah,
strong language, right? So um, I do think it's an important thing to keep an eye on.
yeah.
All right.
Yeah, I'll read this one. So 2025 year-end foreclosure report. Adam reports nationwide foreclosure filings are up 10% year over year in 2025. 367,000 properties had foreclosed, while given a slight uptick year over year, it's still down 25% from pre-pandemic 2019. Distress was observed with borrowers in high leverage and adjustable rate exposure. That sounds familiar.
Hmm.
And early stage delinquency suggests a potential increase in 2026. I, I looked at it and yeah, on the surface, like, oh, wow, 10%, that's concerning. But if you look at the raw data on the number of foreclosures, there was a, there was a, they showed basically, I think it was all the way back to 2025. And if you take out the COVID years when people couldn't foreclose, like it's the low, there was no year all the way back to 2025, there was no year as low as 367. Um, and honestly, it wasn't even close. Like I think 2005 was the lowest, and there were like 530,000 foreclosures. And that was with crappy underwriting and a lot less people. Now, obviously our population's grown over the last 20 years, and to have less foreclosures, I think it's much ado about nothing, to be honest with you. I don't really think it's going to make much difference.
Yeah, I tried to say, how does this compare to the great financial crisis when the last time whenever we truly had a foreclosure issue? And at the peak of foreclosure starts, 4% of all mortgages were at some stage of foreclosure. So, while we were up 10% year over year, there's really not a market that's even, in that zip code, right? I mean, we're talking 0.44%, Texas 0.3%. I mean, that's back then it was 4%. Like we're talking a massive difference.
Yeah.
And we've talked about this some in the past, but the biggest differences are the underwriting approach is vastly different than it was in the past. You have to have higher FICO scores. Everybody has to have documented income. There are no more stated income for owner occupants anymore. You have to document your income, even if it's bank statements. You would have to document some proven ability to pay. The elimination of negative amortization mortgages, really ARMs being a very low percentage of the overall transactions today. and just stronger overall underwriting principles in general and a lot more attention to fraud has made the quality of the mortgages, I think I mean, they're not even comparable to what they were back in the great financial crisis.
Yeah, no, I agree. I think it's fine.
Yeah. All right. Let's go over this next slide. And this is talking about the overall affordability. And we're going to talk about the affordability index a little bit later on, but this is a very interesting statistic that Fortune says that from, 2019, kind of that pre-COVID era to today, the overall cost of owning the average home in the United States is 150% higher. And I can tell you without question, wages have not gone up that same amount. And it's driven by prices, rates, taxes, insurance. And that definitely has put a lot of pressure, downward pressure on prices, you would assume. But we just haven't seen that happen. I think it's in large part because not as much inventory as you might assume. But that's a pretty major difference. And then one interesting thing, which I've personally experienced in my single family rental portfolio as well as personal properties, um, the increase going up 20 to 30% on insurance. And one other thing to always keep in mind if you're a single family investor is you want to always be reevaluating your portfolio. That's something that I'm doing right now and looking at properties and I'd probably say the biggest difference, insurance premiums going up is a significant one, but the more significant one is if you have a property that was not in a flood zone that ends up in a flood zone, that can be something that you really have to look at, and it could eat up a significant portion, if not all, of your cash flow.
Yeah, I mean, I just thought it was interesting looking at the states and
Yep.
they're all natural disaster related, right? Florida, Louisiana, Oklahoma, the tornadoes, Texas, we get them both. So I don't know Colorado. I don't know if they get not sure what is up with Colorado, but yeah, I thought it was interesting. Um,
I guess that may just
and
be uh, snow related. I'm not sure. Like
I
there's
don't
a lot of
know.
things
I don't
related.
know. Um, but yeah, and it's just things are getting more expensive, right? So you always got to figure out what to do with that. What's actionable? Well, if and I was reading some articles about people just being okay to rent. A lot more people are just happy to rent these days. So if you are able to get into some of these, obviously get into some rental properties, you're going to have more people that can't afford to buy homes, therefore more renters. As people age and get families, they might want a house relative to an apartment. So what I take away from the 150 is you're going to have a lot more renters, um, until things change, you're going to have more people looking to rent.
Yeah, for sure. This next slide, it's some of the information that we've seen, just in the individual I'm sorry, city by city data. So it's not surprising that Dallas led the way with a 5.71% decrease. But it is interesting that year over year, out of these groups which were measured, it's the second highest decrease. That's an interesting
Yeah.
tidbit. We happen to work with quite a few wholesalers, including like Michael Seago on transactions, and he's doing a lot of deals in that Beaumont Port Arthur area. And that reduction in price is interesting. One thing I will say, in addition to that, is that one of the unique things about that market is we do see lower out of pocket there than just about anywhere else, and it is a good blue collar market. So if you're looking to get into some properties with lower out of pocket than you would find in some of the other major metros, that area is very good because if you think about it, there's not as much competition. We're able to finance 75% as a hard money lender on almost every property in that area. And then we don't have a loan to cost requirement. And then we're also able to refinance either at 75 or 80% with both conventional and DSCR loans on the backside. So because you're able to buy at more of a discount there because of less competition, there are a lot of deals that are either no out of pocket or maybe 5 or 10 grand out of pocket in that area. It just makes it really attractive because the rent rates are also very strong relative to the price points because it's a good rental blue collar area. Like we see some properties over there that sometimes have $300-400 cash flow with very low out of pocket. That's just not something you see those type of numbers in the major metros right now.
Yeah, no, 100%. 100%. Like the thing is, everyone talks about diversity in stocks, but if you want to diversify, and if you don't, if you don't mind having a property in Beaumont, Port Arthur, which is a little further out from Houston, like it is, because you're picking up properties here in the major metros, and the cash flows are weaker because of all the things we talked about, rents. I'm sorry, not rents so much, but mostly rates and insurance. But you are able to pick up some cash flow winners out in the tertiary markets like that to kind of balance out your portfolio so that you do have some properties with really good cash flows. Because you're right, like I on the DSCR loans, I never worry about DSCR on these Beaumont deals or Port Arthur
Hmm.
deals.
Never.
I know they're going to be well over one. You're not getting at the best possible terms because of it. Not that you can't get a loan below one, you certainly can, but you get better terms above one. So
Sure.
it's a great way to kind of balance out if you're buying in the city, even in the suburbs with less cash flow.
Yeah. Two other data points here I thought were interesting. Whenever we said we do not consider Dallas to be a long-term downward trend, I think the normally the best indicator that rents and home prices are going to go up or down is labor data showing average earnings growth. And Dallas is up 6.4% year over year. That's a very, very strong number,
Yep.
significantly higher than current inflation, which is in that, mid two-ish to high two-ish range at the moment. So that's a really good number. So I think that's a good indicator that rent rates and home prices should recover there. And then, we look at this affordability index, and it doesn't necessarily show the national median, which I really like here. If you think about it, we consider Dallas and Austin like expensive areas, but the median is 410. Dallas is still, the greater Dallas area is still below that. Austin is slightly above it. And, Houston well below it. San Antonio definitely way below that too. So, um, whenever you think about, all the top, you're talking about several top 10 cities, top 10 amenities, sports franchises, access to entertainment, all those things, and being below the median home price nationwide. That's another reason we think nothing but good indicators going forward for Texas real estate.
Yeah, no, you're right. It's funny because like it's all relative because Dallas is pretty pricey, but it's cheaper than the average house in the country.
That includes a lot of small towns, which is
Yeah. Yeah.
uh, all right. Uh, Jeff, what do you see on this next
Next
slide here?
slide.
Oh,
There we go. U-Haul, top U.S. growth metros. This has become an interesting little, almost like a political uh, chart. But Texas placed multiple metros in U-Haul's top 20 top rankings for 2025. DFW and Houston near the top nationally. Net inbound migration to Texas exceeded 200,000 households in 2025. And like you said, affordability, employment growth, tax structure are the key drivers. Population growth continues to directly support long-term housing and rental demand. So 2025, even though Dallas was the top growing metro in the country, they had those price drops. So I do think it's probably a temporary thing. Dallas is one, Houston's two. And then if you look down there, little Brownsville, McAllen, the Valley was 10th. So it's just kind of supporting what we've been talking about. It's good jobs, low affordability relative to the rest of the country, and no state income tax. Those three things, and just overall taxes are lower in Texas. So it's people vote with their feet, I guess, and they're voting to move to Texas primarily.
yeah. I'm going to give a little bit of color to that if you that I think is going to regarding taxes. I saw an article recently that I thought was very interesting, and it showed the average tax per person by state. It was comparing three states, right? California, Texas, and Florida. The average tax per person, California, 10,319. This includes everything. The average tax per person that the state collects. Keep in mind, right? This is the state. This is not overall tax, not insurance. Like this is not including income taxes. This is state
Yeah.
taxes. Texas,
But it does include things like property taxes, right?
yes,
Yeah.
includes property taxes as well. Texas is at 5,469. Because I hear people make the argument that because of property taxes, Texas is comparable, but it's literally almost half. Florida is actually even farther below that at 4,914. I saw that their governor is entertaining eliminating property taxes as well, which would probably get a lot more people moving into that state. So you would say with that surplus, you would think that maybe California has a budget surplus, but the article goes on to talk about how Texas has a budget surplus. It's 24th highest surplus. And currently, at the moment, per person, California has a negative $21,800 negative, despite collecting 10,000 more. So it sounds, if I'm doing this math correctly, that they're spending somewhere around 30 30,000 plus per resident there, which sounds like
Sounds like
a
a
really
spending problem.
sustainable number. Yeah. Against the
That
wealth
sounds like,
tax that I think they're considering putting in place.
yeah,
Another
yeah,
interesting thing about that type of tax is that a fun fact is that the whenever the income tax was first put in place, it only impacted 1% of Americans. And everyone was told that it would never expand beyond that. It was only for the wealthiest. Of course,
yeah,
we all know now everybody pays income tax.
yeah.
So,
Yep.
all right.
Next slide.
All right. So this one is interesting. It's kind of like a dot plot graph, which makes it very interesting because it's talking about the best markets for buyers, and they use a couple different factors to determine that. But we've been talking about this. Sometimes people get scared whenever home prices are down a little bit. Is a good time to invest in real estate. That's the same time whenever people are often afraid to invest in the stock market. But people that invested in the stock market in the middle of the great financial crisis, they were the people that had the best returns. People that sold lost the most money, right? So it's not important to only buy when everything is perfect, but they use a couple different trends in this. David did a really good job finding this report. So it's fluctuation of market trends, affordability to monthly burdens, and negotiation leverage. So in other words, I think that includes things like how many properties are on the market, and then also how many properties are have price reductions, right? So whenever you bake all of these things in, you can see that it's a really good buyer's market for most of those Texas-based markets. You got Dallas down here in this lower bottom left quartile of more affordable and less
Yep.
competition. You got Dallas there. You got San Antonio there. So when you look at all these factors, and several of these metros claimed top spots of most affordable, San Antonio being in 21st, Dallas 26th, and Austin 32nd. So um, very good statistics overall there.
Yeah. I mean, just you want to, if you're buying investment properties, you want to be in that bottom left hand corner, and because there's less competition and it's more affordable, right? What it's pretty obvious. Don't do a lot of you don't want to do a lot of deals in that upper right hand quadrant.
All right. What do you see on this next one? Annual rent survey, Jeff.
So here we go. National rents grew 3 to 4% in 2025, slower than prior years, but still elevated. And this is kind of what I was talking about. The survey conducted by Zumper reported that affordability remains the highest issue, with 59% of responders spent more than 30% of their income. Interesting insights for the survey: 45% of pet owners, 30 say eco-friendly features are important. Um, you know, basically, like I was saying a few slides ago, um, I think this is the more that affordability remains an issue. I think the renting population is going to grow, and I think you're going to be in a good spot if you own rental properties.
Yeah. This next slide is interesting as well, talking about rental market competitiveness. And it uses a couple different factors, five different factors: occupancy rate, days vacant, renters per unit, renewal lease rate, and rental inventory. And it says that it's more competitive. So this is talking about from the perspective of the tenant, not the landlord,
Yeah,
that things are more competitive at the moment, which is not surprising because there are fewer people buying homes. Um, that is a leading indicator that we should see some rent rate increases, although they have not been significant at this point. Dallas is even down a bit. But if it's more competitive, it should lead to higher prices over time. And, some of these markets, Texas, Southwest in general, is not as bad as some other areas. It's a little bit more competitive than, what you've got going on in the West there, but it's not as competitive as some other markets like Florida seems incredibly competitive. The Northeast, Midwest seem incredibly competitive. But Texas is one of the less competitive areas at the moment, and that's not entirely surprising because you're not seeing as much upward pressure on rents. One of the good things about Texas that keeps prices down is that we have a little bit more inventory, right? So there's not going to be as much pressure in some of these areas where there's probably a little bit less inventory. But we're going to show some other things in a moment. There's a lot fewer units coming on as far as apartment units. There's less new construction in single family space because of where rates are. So I do think there's going to be a little bit less new inventory coming on board, and that should, combined with upward pressure on income, lead to some increased rents over time.
Next slide. So Yardy's multifamily outlook for 2026. New report from Yardy projects the U.S. multifamily market faces a series of challenges leading into 26 that are likely to keep rent growth positive but modest through the year. So these are for the multifamily owners. Forecast would be a 1.2 increase in rents for 2026, with moderate growth continuing its strong demand and supply growth characterized by the Sun Belt and Mountain West regions. Predicted 450,000 units will be delivered in 2026, a drop from recent years' average of 500 to 600K, but not enough to push forecasted rents to robust levels. I know you talk to folks that do multifamily, and I know recently there's been some challenges. Anything you talk to lately that's changed that in the multifamily and the big apartment complexes?
I Not that I no, I don't think there's a big change in that I've heard of. Now,
Yeah.
I'm not, I know a few of the guys in that space. I was looking at doing a little bit more passive things in the past. I'm not looking at any things at the moment, so I'm not as engaged in that space. I don't know that I'd have a great anecdotal opinion on it.
Yeah.
Um, let's look over at the national rental vacancy rate. That's another interesting component here. And whenever we look at this, we see that it would make sense because the vacancy rates are a little bit coming up. They're trending up, that there would not be as much price pressure as there was back in COVID. But the rental vacancy rates are still historically pretty darn low. Obviously, whenever anybody with a pulse could buy a house during the great financial crisis, um, there was not as many renters because everybody was just buying and buying, buy multiple houses pretty easily. Um, so I don't think that trend is overly concerning based historically, but I think that explains a little bit of why we're not seeing big increases in rent rates despite some increases in the overall income levels in the markets in which we're concerned about, and primarily the people on this call are concerned about.
Yeah. Like I said, as if things get a little easier to buy a house, which because it's all relative, which it sounds like it's getting that way, the easier it is to buy a house, the more rental vacancy you're going to have. So it may go up a little bit, but I would not expect much move at all this year.
All right, let's look at this next slide. What do you see here, Jeff?
So rates 6.09 in January, or 6.22 in December. Um, this is an interesting chart only because, well, not only, but one of the biggest things is it just gives some perspective. Everyone that's in the market, there's a lot of recency bias, obviously, because if you look at the chart, really starting around the early 2000s, rates were lower than they are now. I would say right in 2010, they were significantly lower. But if you go back I guess that probably starts around 1970, for the not overwhelming, but for the majority of this chart, rates are lower now. And it's definitely averages because you had that giant spike, say, from like the 80 to 86. They're significantly lower than the average rate people have seen over the last 50 years. So while, like I said, everything is relative, and they're higher now than they were recently. Obviously, overall, they're normalized numbers, I would say. This is
Yeah.
about what historically you're looking at for mortgage rates. And I'm not sure what is going to happen this year. I've seen some people think, if there's a change in the Fed, we're going to have a lot more reductions. But like I said, the one we did earlier today, they thought it was going to be right around 6% for the most of the year. So we will see.
I would tend to say this, everyone can have their own opinions on the current administration, but he has said many times, the president has said, the person who's going to be selecting the new head of the Fed, that he thinks rates should be far lower. I have a guess that question's probably coming up in the interview process. Uh, and while I,
So
I would agree that it's probably healthy to have more separation in responsibilities, then he's probably exerting more pressure on that group than might be healthy. I don't know. But at the end of the day, I can tell you this: if I'm in the mortgage business, or if I'm an investor and I'm hoping that rates come down a little bit, him saying this often that he wants rate lower, I'm pretty sure he's going to hire somebody who's on board with that for the most part, at least saying they are at the moment. So I tend to think that rates will be lowered quite a bit. In fact, the person who's favored on Polymarket to get the role, I think, said that he would think that rates should be reduced significantly, maybe 100 basis points very quickly. So that doesn't mean that that person necessarily going to get the job. That's just a betting market. But I tend to think that there could be some pretty quick rate reductions based on the person who's picking the job, person for the job.
hmm, interesting.
All
Who
right.
was it, by the way?
I can't remember the guy's name off the top of my head,
Oh,
Jeff.
I'll look it up.
You're giving me way too much credit for memory if you think I remember the guy's name. I just remember I got very excited when I heard 100 basis point reduction. That's what
That's
locked that's what
all
locked
I
in
heard.
very strong, very strong. I
Protect
was
that
very
name with everything we've got.
excited. All right, let's look at the portability index. Jeff, what are you seeing here?
So it just, if you haven't been on here before, this is it's a ranking of U.S. markets from 1 to 100. Um, the number one is the least affordable. So it's a percentage of your income relative to what your mortgage payment would be. So, for example, in LA, the average household income is 88,000. Average price is 1.1 million. That would eat up 84% of somebody's monthly income, and then it goes down from there. I do think it's interesting that like Dallas, despite the pullback we were talking about, and more income, they're still around 18. They were they're 18. They were 19 last year, 21 the year before. I'm sorry, that's 6 years ago. So not a lot of massive movements, to be honest with you.
One
Um,
thing I find, one thing you got to keep in mind though with Dallas, Jeff, is that you see it is in this particular report a far more bifurcated market.
yes,
Like you've got
yes.
if you go down, you got Dallas at
Irving,
17,
Plano. Yep.
yeah, and a lot of the higher income areas are really really strong on here, right? Irving, Plano, Arlington, Fort Worth, Garland. There's a lot of areas on here that are really really attractive. If you bake that in with that Dallas number,
Yeah.
that comes down much more into a range like I'm assuming more of a range like Austin, probably all the way down to Houston, probably closer to a 40% type range.
No, you're right. That's a good point. Um, but it just shows, like you said, when you're up in the high ranking markets, like there's just no way for investors to do deals up there and make money unless you're finding some flips. But down in Texas, like you said, a lot of like Fort Worth, San Antonio, Arlington, obviously Houston. Um, we got little Lubbock down there, 94. But
Yeah.
um, but yeah, it's just we're in a good spot. A lot more, 30% of your income for your mortgage is a whole lot more feasible than 75 or 80%. Although it is lower, if you notice, like if you look in the last year, it was all the way up at 96% in LA. And I guess they've had some pullback, is my guess, is why that is the way it is. Um, it's down to 83, but yeah, it's just another good reason why Texas is a pretty strong market.
Oh, just comparing a couple things here that I think are interesting. Houston went from 41% to 43% down to 37% now. That's not a big price reduction, but it doesn't look as though the Houston earnings is up pretty significantly, right? The
6K.
household
Yeah.
income, yeah, household income's way up. Uh, Tell you what, where else household income is up like crazy. Look at Los Angeles from pre-COVID, 54,000 to 88,000.
What the hell?
I don't know what's going on over there, but man,
Well,
they
they
got
changed the map or something. That is a
uh,
massive
that is an
difference.
unbelievable difference.
Well,
But you
look
know
at
the we
Miami. Look at Miami, 33 to 65. I don't know what's going on down there.
yeah, that's some voodoo math. I don't know what that means, but
Yeah.
um, the one thing I will talk about San Antonio, we were talking about this a while back because you look at it just on affordability, and the Houston and San Antonio incomes have been very closely aligned. You look back in 2025, Houston and San Antonio, 62 and 63. Uh, Back in the day, pre-COVID, 49 and 49, right? And today they're still 69 and 69. But the average home in Houston's 349. The average home in San Antonio is still way down at 264.9. So I do tend to think San Antonio has a lot of upside. One of the most affordable markets in Texas, and as far as a major metro, just extremely affordable overall. So
Yeah.
it's not surprising to me that they had the highest year over year appreciation. I think that's a trend that could really continue.
Well, we're making a big deal of the income jump in LA. I think look at Austin, and they had a lot of tech boom, but they've gone from 63 to 100. So it
Wow.
is. There's a lot of markets have had a massive jump in their income.
Yeah, that's pretty incredible.
So,
Yep. All right, David, do we happen to have any questions today?
Yeah, so
Okay.
we actually had quite a few questions come up as we were going through the presentation. So I'll just read off a few of them for everyone. So the first question was regarding the insurance cost increase. At what point would you see insurance cost being a deal breaker?
I don't think it's ever a deal breaker. It really just, in and of itself, right? You're looking at your overall expenses relative to your overall revenue to determine cash flow and then cash on cash return. And then one thing I would encourage is that people don't just make a pure cash flow evaluation, make a return on investment evaluation. In the current environment, like Jeff talked about earlier, you're not going to see $400 cash flow very often unless you're out in Beaumont or a very tertiary market. But what you will see is superior ROIs in a lot of instances, return on investments or cash on cash returns to what was available back whenever rates were really low because the out of pockets were so high. In the peak of COVID for an entire year, the average out of pocket that we did was like 45K. Right now, that number's closer to 15, 17.5, something like that. I haven't checked it in the most recent time, but because of that, you can make one third as much cash flow and still have a comparable ROI, which is pretty common right now.
Gotcha. Thanks, Wade. So another question that we had is regarding the buyer's market. Uh, Basically, are you seeing price reductions in the deals you are lending to? What's the most common reduction you see?
I don't think we're seeing price reductions necessarily. When we talk about deals getting under contract, they typically there are not price reductions. Um, if that's what you're referring to, I don't see a lot of that. I would not go into a deal thinking you're getting a price reduction. Now, if it's before you put it under contract, then for sure you want to offer what you think is the right number for your deal. And if whether you make if you make 20 offers, all it takes is one, right? And you get your deal. But I don't see we're not seeing a lot. I'm not seeing a lot of price reductions for deals under contract. Um, I don't know about you, but I just don't see that. I would not go into a
Yeah,
deal expecting that.
yeah. I would say there's two different times whenever you make offers, right? One is from distressed sellers. Um, I think there's a good chance that you could get price reductions there in some circumstances. Like if you, to Jeff's point, if you think the right number, you got a $50,000 repair budget, The person has it listed for 150 and it's worth 200. Obviously, you can't pay 150. That math doesn't work. Make an offer at the price you feel is right. And you have to make a lot of offers, but people are having some success with that for sure. If you're dealing with wholesalers, one thing that's important is if you want to be a volume buyer, I think it's very important that you understand the psychology there, that they probably, in most instances, are not making a ton of money on most assignments, and that it's a relatively high cost to market environment. So if you come and try and beat them up on price every time, the odds that you're going to build a relationship where you can consistently buy the properties that you want to buy and be a volume player is difficult. So just understand the relationship. Obviously, if they're way out of whack, you can let them know what the number is. But in my experience, if you want to build quality relationships with wholesalers, it's best to try and make it work at the number that they've given you because there's a good chance somebody is going to pay that if it's a good quality, ethical wholesaler.
Gotcha. Thank you, guys. One question here also from Tam. Tam wanted to know what's the one thing investors should stop worrying about and one thing we should be paying
Hmm.
more attention to lately.
Hmm.
It's
That's
a
a
good
very deep
question.
question, Tim. Anything investors should stop worrying about. Okay.
I,
Go ahead. You go first,
I
Jeff.
have one for what they should pay more attention to. I really think you should pay attention to the relationship you have with your general contractor. I think having a GC dialed in, knowing that you're going to get a solid bid up front, you're not going to get change ordered to death. That because that is the one thing that can not the one thing, but that is the most likely thing to possibly sink your deal is if you get into a deal making offers and you think your numbers are X and it turns out the rehab is going to be another 20, 30, 40, $50,000. That's obviously a big problem. So I think the most important thing is to really have a team, and part of that team should be a general contractor that you know, that you trust. It doesn't have to be the cheapest. It's just they need to be able to execute on what they tell you. Um, I think that's key.
I completely agree. That's a great point, Jeff. Um, I think getting the cheapest contractor or the cheapest bid is not always the right solution because the Jeff point, they will often change order you. They will lowball you just to get the deal, and then they change order you to death. And it is very difficult. One of the most difficult things to do is to change a contractor halfway through because the new contractor is going to say the work wasn't done right and they got to do it all over again. Especially if they're in an area like San Antonio where you have something like the strike team and a lot of things
Yeah.
have to be permitted. It's even more problematic. But in general, you want to do everything you can to make that relationship stick, even if it means paying some change orders. But either working with great mentorship organizations like Total Wealth Academy or something like that, where you have contractors who have reputational risk and have been somewhat vetted, that's very, very important. Or working with a good referral source. But like most things in life, cheapest is not always best. That's for sure. Um, the one thing I think they should stop worrying about, I would say two things I would say to that. One, interest rates. It's just a function of doing business, and in a high rate environment, rates can go down. That's a good thing for buy and hold investors, right? You can never change your out of pocket up front, but you can refinance your interest rate and get more cash flow. So I think people are over fixated on interest rate at the moment. The other thing I would say is that we're not in a high appreciation market. I hear some people say it's the wrong time to invest because we're not in a high appreciation market. What I can tell you at that time, there was so much competition that everybody was having to overpay to get a deal. Just like you had to overpay to buy a house back in COVID. Like there were 15 offers on every house. Every deal was going well over ask price. And that's not the best time to buy a house whenever there's so much competition. So I do think two things that savvy investors understand. People who've been through the great financial crisis or have at least read about it understand that when you're in a buyer's market is a really good time to invest if you make good decisions. It's not the easiest time to flip, but it is a great time to buy and holds. And you can flip in this market if you make good decisions, right? And do most importantly, I think, to your point about GCs, put out a high quality product that is differentiated from the other houses on the market.
Yeah. And people ask, how do you get GCs? Ask, get referrals, get references. Do they have an online presence? Are they sponsors at mentorship groups? Not everybody has to be that, but it's a great place to start.
Yeah.
Gotcha. Thanks, guys. And just wanted to announce our winner for half off processing for hard money is going to be Joe Morales for our webinar today. So thank you, Joe, for tuning in. And we did have one last question. If you guys have time, just a couple minutes.
Sure, sure.
Jamie was asking which areas in Houston do you see opportunities for flippers and which ones for landlords or buy and hold?
Uh, I I don't know that we see any particular areas that I can say like zip codes or anything like that. What I would say is this, um, just understand the price points and, in general, you're going to have better rental opportunities below 375K and out in the suburbs, things like that are going to be better. Your flip opportunities are going to be a little bit better, whenever you have higher price points in most instances because you're not competing against landlords to buy the property. It's hard to buy at 75% of after repairs value if you have people that are willing to pay up on that because it's at a landlord price point. So just understand your objective and you want to make that decision before you do, before you buy the property, before you up with your plan. You need to know what you want to do. It's okay to have multiple exit strategies, but you definitely want to have a primary exit strategy. And then what I would do is try to find areas where it does seem like the market's turning over more quickly and where you can see the comps and you have confidence in your personal ability and your contractor's ability to execute at that level if you're a flipper. Like you have to put out a product that's hopefully a little bit better than the market. And if you can do that at a reasonable price and buy at that level, then I think that could be a good market for flippers that,
Yeah,
has some reasonable market turnover.
yeah, that's well said.
All right.
Alrighty. One last one. I want to give it one. Tam asked one more question, so I want to give because
Okay.
I did like her question before, so I want to give her one more that I think it's good to end on. So, what would be your one piece of advice for 2026 going into 2026? What's
Buy a
one
house.
one one
Buy
piece
a
of
house.
buy a house?
Don't
Don't,
don't overeducate. I mean, was it analysis by paralysis? Like just get in the game. If you've never done a deal before, get yourself a good team. Obviously, a lender like us, hopefully. Get yourself a GC, an insurance agent. But just you spend all this time doing the research. Just do a deal. Just do a deal. Um, that's my one piece of advice. Don't 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 stay on the sidelines too long.
I'm gonna I'm gonna say that's really good advice. I'm not gonna add anything to that.
All right.
Alrighty, thank you guys. That's all the
Thank you.
questions.
Nice
All
job,
right. Thanks,
David.
everybody.
Thanks, Jeff. Have a great day.